Not me. Oh. Okay, good. So someone should please read the question for us. Question 6.
Good evening, sir.
Yeah, good evening, ma'am.
Good evening, everybody. Question 6. Can you hear me?
Yes, please. Go ahead.
Abakan Bank is a microfinance bank, the bank, which has recently made the transition to IFRS 9 financial instruments. The bank is working through the classification and measurement provisions under IFRS and have requested your firm to provide some guidance. You are the senior consultant on the engagement, and the following notes were taken during the meeting you have just attended. Meeting note: the bank has invested in debt instruments of the Federal Government of Nigeria (FGN) bonds. The bank's strategy is to hold these instruments until maturity and receive the contractual cash flow, solely principal and interest, accruing from these debt investments. The bank is known to sell some of these instruments prior to maturity. The last sale occurred about 5 years ago, and all instruments held since then have been held until their maturity dates. The sale of debt instruments that occurred 5 years ago amounts to less than 2% of the bank's entire portfolio of debt investment. The directors of the bank do not have any accounting mismatch to consider. In addition to this investment in debt instruments, the bank also has investments that are classified at fair value through profit or loss. The gain and losses on these investments are recognized in the statement of profit or loss. The directors do not recognize a loss allowance for expected credit loss on these investments. At year-end, the bank is considering its fair value disclosures in its financial statement. A senior analyst at the bank refers you to the fair value hierarchy guidance outlined in fair value IFRS 13 fair value measurement, but is unsure how to apply to its holding of FNG bonds. The FGN bonds are issued with a set coupon. This yields on the bond and the value of the bond are then set in the open market trading. Required. Discuss briefly how debt investments should be classified by the bank in accordance with IFRS 9. B. Comment briefly if a loss allowance for expected credit losses is to be maintained by the bank in relation to the financial instruments measured at fair value through profit or loss. Advise the senior analyst at the bank on the fair value hierarchy. The FGN bonds will be categorized in accordance with IFRS 13 fair value measurements. Thank you.
Thank you very much for that. Now, before we go into the question, please, I want you all to take note of this direct question, May 2024. May 2024, question 4. That's our question for next week. May 2024, question 4. Are we taking note of it? That's on Liz. Please, May 2024, question 4, please take note of it. So that by next week, we have one question already. Shall we proceed into today's question? Shall we?
Yes. Continue
Okay,
now.
now the question is asking us, how do we classify IFRS 9? Yes, can someone come out to that? Can someone help us with that? How do we classify IFRS 9?
Listen,
Yes.
Yes.
IFRS 9 is according to the way it is being measured.
Mm,
We have, based on the measurement, when we are classifying it according to the
mm,
model of measurement, it is classified as an amortized cost,
one.
and it classified as fair value through profit or loss, and fair value through OCI.
Okay, thank you very much for that. Now, before we even go into the question, what type of financial instrument is this? Is it a financial asset or a financial liability?
Financial assets.
Why is it a
Financial
financial
assets,
asset?
because they are investments.
Because it's an investment, federal government bonds, right? Right? Investment
Yes.
is
Investment.
an instrument. Investment in federal government bonds. So it's an asset to the company or to the individual taking this up. So to the company now, it's an asset. And we classify it in three ways, right? So an amortized cost, right? And classify under fair value through CI and through P&L, right? Am I right? So can we discuss that? Classified as amortized cost. Who can briefly explain it, briefly discuss?
Let
Yes?
me let me briefly explain it.
Thank you. Go ahead.
The one that is being classified as amortized cost means that the sole objective of the entity holding that asset is to hold it to the maturity date in order to collect the contractual cash flow in form of the interest and the principal invested. The
Okay.
principal invested. And the one that is being classified as at fair value through OCI is the asset that the main objective of the model objective of the holder of the entity holding it is to hold it to maturity to collect the contractual cash flow as well as the interest, and equally to sell it when need arise. But the main objective is not for trading. That is, it serves dual purposes. It is kept for maturity, and it can also be sold within the period before the maturity date. Then the one that is being classified at fair value through profit or loss is the one that the objective of that entity holding the asset is mainly for trading. That is for speculation. That is when they will just observe the market condition, and when the price of that asset goes up, then they sell it off. Thank you. This is my attempt.
Thank you very much for that. And I like the fact that it is very comprehensive, very short and concise. Honestly, if you write that out, you can get the whole 7 marks. Do we have anyone who wants to add to it? She has actually done justice to the question. All right. But do we have anyone who wants to add one or two things to it? Eh? Do we understand what she said, or you want her to repeat it?
She can run through it briefly.
Okay. Please, can you please take it again, madam? Can you please run it through us? Run us through it again, please.
Okay, so I said initially that measure the classification of financial assets according to IFRS 9 is based on the model of which at which they are measured. It is based on their model of measurement. And on measurement, we have three different ways for which it can be measured. It can be measured at an amortized cost. It can be measured at fair value through other comprehensive income. And lastly, it can be measured at fair value through profit or loss. Now, the explanation of these three classes of measurements. The one that is being measured at an amortized cost, it's that it is being measured through an amortized cost means that the sole objective of the entity holding that asset is to hold it to maturity in order to collect the contractual cash flow in form of the interest, the annual interest, which the entity will be collecting until the maturity, and the principal amount that is being invested. That is at an amortized cost. Then the one that is being measured at fair value through OCI, the objective of that entity holding that asset is to hold it to maturity, just like the one I mentioned earlier. But the difference between this one and the one at an amortized cost is that amortized cost has no objective at all for trading on it. It's just for maturity to collect the contractual cash flow. Meanwhile, through OCI is the one that is being kept at maturity to collect the contractual cash flow and the principal at the maturity date. And also it can be traded. It can once in a while be traded, but the sole aim is not for trading. It serves dual purposes. Then the one that is being measured as fair value through profit or loss is the one that the sole objective of the entity holding it is mainly for trading. That is, it works in speculation. They will just closely observe the market, and when the prices of that asset goes up, it will be sold. That is, it is held for trading purposes. Thank you.
Thank you very much. Thank you very much. I think that's very, very comprehensive enough. Do you want me to run through it? So in actual sense, this is what she's saying, right? The one at amortized cost, right? The objective is to hold it to maturity and collect the contractual cash flow from it. All right, that is, you collect both the principal and the interest. All right, the interest and the outstanding principal of the financial assets. The objective is not to sell it. Now, that is for amortized cost. The one for OCI is to collect as well. Yes, to collect the contractual cash flow, and also you can sell the financial assets. So this one means that you are collecting the contractual cash flow and you can also sell the financial asset, even though it is not the main objective. But of course, you collect the financial cash flow, contractual cash flow from it, and then sell of the financial assets. While the other one, which is through P&L account, the only objective there is to sell the financial assets. And that's what we have. Thank you very much for that. That was very comprehensive enough. Now, for how will this bank now classify? Now, don't forget, this is a federal government bond, right? Am I right?
Yes, sir.
And the company has a policy. If you look at the question, the company has a policy of selling it before maturity. Am I right? Am I right? Okay, let me bring out the information. Now, see, the bank has invested in debt instruments of FGN. The bank strategy is to hold this instrument until maturity, Okay. It is to hold the instrument until maturity and receive the contractual cash flow, solely the principal and interest accruing from this debt investment. Now, the bank is also known. It's known to sell some of these instruments prior to maturity. Right? Now, the company can hold it. Abacam Bank, the bank can hold it to maturity. But they also have it that they can sell off some of these items before maturity. Am I right?
Yes, sir.
Okay. So if it can be sold before maturity, where do we classify it now? You can see the two things there, right? To collect, to receive the contractual cash flow, and also they are known to sell the instruments, some of the instruments before maturity. What are the two things there? The two things are there, two information are there. So how do we classify this?
Can be classified as fair
value through
Fair value through what?
OCI.
Exactly. Fair value through OCI. It has the information there. Now, the last sale occurred 5 years ago, and all instruments held since then have been held until maturity date. Yes, they've been held until maturity date, but they are known to sell off some of the instruments and then hold some, right, and receive the contractual cash flow. I think that one explains that. Now, in addition, the investments, the bank also invested in. The bank has investment that are classified under fair value through P&L. The gain and losses, that one has nothing to do with us. Now, we've answered the question now. How is the company expected, how is Abacam Bank expected to classify it? They have to classify it as fair value through OCI. As simple as that. Now, comment briefly if a loss allowance for expected credit losses is to be maintained by the bank in relation to the financial instrument measured at fair value through P&L. Yes? And this is it. In addition to the debt instruments, the bank has investment that is classified through P&L. The gains and losses on these investments are recognized in the P&L account. The directors do not recognize a loss allowance for expected credit losses on this investment. Yes, so what do we do? Comment briefly. If a loss allowance for expected credit losses is to be maintained in the bank in relation to their financial instruments, yes, what do we do to that?
Please, can you explain this in the English?
So the question is asking you that what do you do if there is a loss on allowance for expected credit losses? If it is to be maintained in the bank, how do you recognize it? If you are to leave it in the bank, how do you record it? How do you recognize it in the bank?
I think it should be expensed.
It should be expensed. Okay, tell us more. Yes. Don't forget, the loss has not occurred. It is expected.
As in
It is an
provision.
expected loss. Right? So what do we do when we have an expected loss like that?
We make provision for it.
Make provision. How do we make provision for it? How do we measure it?
That's
It
fair
is
value.
already measured through fair value through P&L. Abi? So how do we measure it? Now, when you are making provision for a loss like this, don't forget the loss is an expected loss, which means it is a future loss, right? Now, when it is a future loss like this, you are expected to discount it.
Okay.
Yes, okay. Am I right?
Yes, sir.
And again, when you are discounting it, the loss is expected to have a lifetime, right? What's the lifespan of our loss? Are we giving in this question? No. But since it is a future, then definitely that future is not an infinite future. All right. So we are expected to have the number of years the expected loss to cover. Do you understand? Now, it could be something that is within the year. It could be medium term. It could be long term. Am I right? Eh? Hello?
Hi, sir.
Yes, you're
Ah.
right, sir.
So if you have the loss to be short term, let's say within a year, yes, what do we do?
That should be profit or loss. Fair value through profit or loss. But if it's more than a year, it should be amortized cost.
Okay. Don't forget you have measured it through P&L accounts, right? And in fact, the company already recognizes the gain and loss in the P&L accounts. Am I right? Eh? Am I right?
Yes, yes.
Yes, sir.
Now, but one thing about it is now we are expecting a fair value, we are expecting a loss on this particular investment. Now, the bank has other investments like the federal government bond now. Can we offset it? Can we offset that loss against our financial assets?
No.
To just find the net amount? No. Why? Does IFRS restrict us, prevent us from offsetting it? Yes, without wasting time. We cannot offset an asset. All right? And in actual sense, they have different classification. This one is classified through P&L account, through P&L. The other one, we said we have to classify it through what? OCI. Right? Now, even at that, IFRS 9 prohibits also offset a loss allowance from a financial asset. Right? We can't offset it. The fact that you're having a loss, you cannot offset it against the gain from another investment. No. Are we together?
Yes.
Any question on that, please?
So I didn't get that. I think I lost my connection. I just rejoined.
Please tell your connection to stay with us so that we don't have to be going back again. All right?
Apologies, sir. Yes, sir.
No, I understand. It's fine. I understand. But please get a stronger network so that you don't have network issue. All right? That's now we're talking about the credit loss. And we said that the credit loss itself has to be discounted, right? Since this is an expected credit loss, right? Now we have to discount that credit loss using a discounting factor. And of course, it should have a specific period. It could be short term, it could be long term, right? Now the credit loss itself. Do you know what is the credit loss itself, Seth? What is the credit loss itself? Eh? What is that credit loss?
If there is fair value loss on the remeasurement.
Fair value loss. I don't understand. Fair value loss. Fair value loss.
That is at the end of the year. If the amount, if the fair value, if the fair value that is having previously is less than the current one at the end of the year, it means that
So how about we put it this way? Let's say it should be the difference between the contractual cash flow that we mentioned in A above the contractual cash flow we are expecting that is due to us, and the actual cash flow that is eventually received. The value, the difference between that value when we discount it. Don't forget, our contractual cash flow might be something of, how many months is this one? Though it's government, federal government bond. A federal government bond can be more than a year. This one is the last thing, right? The contractual cash flow. Now, what's the difference between that contractual cash flow that is due to us at the end of that investment, when it is time for us to cash out? I hope I can use that word, cash out. When it is time for us to get the contractual cash flow, right? Now, the difference between the contractual cash flow that is due to us and the actual cash flow, or the expected cash flow that we receive after we have discounted it. So let's say we are expecting 5 million naira in the next 2 years. If we discount it to today, no, there will be a difference, right?
Yes, sir.
Discounting factor will reduce your cash flow now, Abby.
Exactly, sir.
Yes.
So
Yes.
the difference between that discounted present value and the cash flow is the credit loss. Do you understand?
Yes, sir.
So that is the credit loss. Now, that credit loss, the expected credit loss, will now be over the lifetime of the expected life of that investment. Do you understand? So like I said now, if I'm expecting 5 million in 2 years' time, right? So that is the expected life. All right? So we need to understand that loss. Now the question says that, comment briefly if a loss allowance for expected credit loss is to be maintained in the book. So if we are to maintain it in the book, what are we expected to do? Yes. Does IFRS 9 permit us to maintain it? Yes, IFRS 9 permits us to maintain it. But the only thing is that we cannot offset it from financial asset, gain from financial asset, or any other financial asset we have. Do we understand, please?
Yes.
Shall we proceed?
Yes, please.
Okay. Question C says that that person can leave, please. Right? Okay. Person has not muted. Hello? Okay, thank you, sir. Advise the senior analyst at the bank on the fair value hierarchy of federal government bond, right? On how it will be categorized in accordance with IFRS 13 fair value measurement. So this question has fair value measurement and it also has IFRS 9. Have we done fair value measurement? Did you do fair value measurement with me? Should we go into it or I skip it for the lecture for the other lecturer? Let's do it. Now, fair value measurement. What are the hierarchy of fair value measurement? I think we did it now. We did fair value measurement in this class. Am I right, please? Hello?
Not yet, sir.
Eh?
We checked you, not yet, sir.
Not yet, sir.
Okay. So you've not done fair value measurement at all. So how do we solve question on it when you've not read it? What do we do? What do we do?
We can keep it when we do fair value measurement. We cannot do the subject.
Okay, that's fine. Now, but let me just quickly run us through it, Sha. It's nothing serious, and I'm thinking we've done it. I'm thinking we've done it actually.
We haven't, sir.
Okay, I believe you. So we have 3 levels for fair value measurements, right? Now, this fair value measurement hierarchy, we use it to categorize inputs, right? Inputs to valuation techniques. That's what we usually use it for. Now, we have, we have 3 levels. Okay. Now, these inputs are used in valuation techniques, right? And we categorize them based on how observable they are in the market. I think we've done these things. How observable they are in the market. IFRS 13, fa. Okay. But I think we've done it. Now, the first hierarchy is that you have a quoted price. When the market, when the price can be quoted on the stock exchange. Don't forget, fair value means the market value. Abi? Am I right? That is, you want to get the value of an item. So you go into the market where all of us, both the customer and the seller, they have full knowledge of what is going on in the market, right? Now, we have 3 things. If you want to get the value of an item, you can get it in 3 different ways, 3 different categories. The first one is that it is quoted on the stock exchange market. That one is highly reliable. That is, that price, it means that anywhere in Nigeria, that is the price. Because it is regulated by the stock exchange market, and everybody on that market uses the same price. So you can easily see it. It's just like if I want to know how much was Dangote sugar as at January 15th of this year. If I go to that market, that stock exchange market, I'll see it there. Do you understand? It is quoted on the stock exchange market. So that's the first hierarchy. A quoted price. That's the first level. Okay? And this quoted price is an unadjustable price. So you cannot adjust it. That is the price everywhere in the world. Even if you are coming from America to buy it, that's the price. You cannot negotiate it.
Okay,
It is an unadjustable price. Do you understand? An unadjustable price for that particular asset or liability. All right? Now, for this question, what do we do to it? I'm asking you. Yes, for this question, what are we to do? Okay, so let's do this way. Let's identify all the things, and then we'll now determine how this bank, what's the name of the bank? Abba Bank, what do they call themselves? Abakan Bank. Abakan Bank. Now, we'll now determine how Abakan Bank should categorize its investment. All right. So now, like I said, the first one is the quoted price, right? Which is an unadjustable price for identical assets and liability. Anyone who is buying that same asset or that liability, you are buying it at the same price. Don't forget, a quoted market. The stock exchange market is an active market, right? So how much can you get that identical asset or liability in the market? And this price is the most reliable price, and it is most objective price. That's number one. Number two is, I would have given you example. I would have told you where this one falls under, but I won't. Let's just move on. Number two is an observable price. An observable input price. Now, this one is not direct. Do you understand? It's not, we don't use the direct market data. They don't quote it directly on the stock market, but they are observable. They can be observable directly, they can be observable indirectly. Do you understand? Now, for instance, That is not the quoted price, so, but we can have a quoted price for similar assets. There's a difference between similar and identical. Similar, closely related. Identical is carbon copy. But you buy in the house. Similar, ofejo. Identical, ojo. Similar, it resemble. Similar. Identical is that they resemble. Similar is it is closely. They have some shared attributes. So this particular one, we can look at the quoted price for similar assets, right? We can look at the interest rates there, and then something called corroboration. Have you heard of corroboration before? We use corroborative evidence in audits. Corroborative evidence is that, let's say, let me use an example of someone in this class. Yeah, myself and Miss Stephanie, let's say we had a conversation sometime back, and then while we're having the conversation, Miss Stephanie now said, like in the middle of the conversation, me that I'm still looking at 30 in front of me. I'm just looking at 30 in front of me. That is, she's saying that she is looking at clocking the age of 30. Right? Now, after saying that, we've had that discussion, we have forgotten it. Let's say a week later, I was now having a conversation with, let's say, Mr. Favor. Is Mr. Favor a male or female? Ugochukwu?
Sir.
It's female. Why is it? Why have all females here? Tell me, Mr. Evans. Is Mr. Evans there?
Evans is a male.
So let's say I was having a conversation with Mr. Evans a week later. And then we're not talking about age. Then someone now says, let's say Mr. Evans now has Miss Sheton. Miss Sheton, you and Miss Stephanie, you're always acting like twins. Are you ladies twins? Then Miss Sheton was just 2 months. That is, I clocked 40 this and she reflected her own 30. Now, that's corroborates Mr. Evans.
Sorry, sir, Miss Evans.
Miss Evans, I thought I was hearing a male voice.
Yes, sorry, I was off.
Okay, someone said Miss Evans. Okay. Now, what Miss Felicia said about I just clocked 30 and Stephanie will be clocking 30 in the next 2 months. Now, don't forget, Mr. Evans.
Mr. Evans, please mute.
Yeah. So don't forget, a week ago, when I was having a conversation with Miss Stephanie, she said she's looking at 30 in front of her. And Miss Felicia said she'll be clocking that Miss Stephanie will be clocking 30 in the next 2 months. Is there any difference in the two statements? No. That is what we call corroborative evidence or corroborative statement, right? Now, we can also have a corroborative market input for an observable input. Corroborative in the sense that someone will tell you this is the price and you will get it in another place that is very corroborative. Like, it might not be the exact figure, but at least it is very closely related. Do you understand? So we can have, that's the second level, which is the observable level. Let's come back to our question. And the third one is, yeah. The third one is an unobservable input. Now, the observable inputs is reliable, but not as reliable as the quoted price. Now, the last one is the unobservable input. This one, you cannot rely on it at all. It's like when they tell you how much they are selling petrol in the black market. Do you understand? So that one, it is not observable in the market at all. And it is usually based on assumption. I can buy my own petrol now, and I'll go by the if I see that lots of people need it, it is based on that assumption that many people need it, that I will hike my price. Do you understand? So that is an unobservable assumption or unobservable input. All right? Aha. And this is what private companies use. Right? Yes, we use it in private companies. Then when you have a very complex financial instrument without any active market, don't forget the quoted price is on the active market. We use quoted price on the active market, but we use unobservable inputs in where there is no active market. All right? Observable, we can use it where there is a similar quoted price, similar quoted price for a similar asset. All right? Now, I've mentioned all the three. Which one do you think? How do you think the bank, Abacam Bank, they classify this bond? How would they classify the bond?
Unobservable input.
Why? Unobservable means black market. Oh. Eh?
Quoted price input.
Why?
Because they have foreseen that the investment will be a credit loss.
That one is a forecast. I'm listening. Go ahead.
Because they have seen it already. They are expecting a loss. So they know that in this market, in this active market, is already a loss.
Okay. So this is it. That person can wait, please. Thank you. Now this is it. In the first place, what type of investment is it? It's a federal government bond. Federal government bond should be on the stock market. Federal government can borrow money in the stock market. They can borrow money. So definitely this one is level 1, quoted price. So whatever money, whatever bond government is issuing out, they are issuing it out at the quoted price. Do you understand? And of course, in the question, there's something about what do we call it? Fair value measurement. Let me look at the information very well. They are working through classification and measurement provision, guidance. Now, it's a debt instrument from the federal government. See, that person who mentioned level 3. You have really got our president to our country, Nigeria. As well now, how can Nigeria, a whole country, and we said it that the third level, which is the unobservable input, we use that one for private organizations, for private companies where there is no active market. We use it for private companies. Private companies use it very well, right? And we also use it where there is no active market. This one, we have fair value measurement. The company can be selling their debt and all of that. We don't care. But for it to be a bond, that you can even expect a loss, a credit loss on the investment. All right? So this one is level 1, not level 3, please. Do we have any other question? Any question?
No question, sir.
Okay. I want us to solve one other question. And that one is on the recognition of IFRS 9. I think I have a question. I have IFRS 13, fair value measurement in May 2021, question 4. Fair value measurement. And that one is also asking you to explain the 3-level hierarchy of fair value again.
àdúgbò iṣẹ́ nílé ní nàìjíríà.
Alade Sanmi, please. So,
Right? So fair value, please take note of this fair value measurement. Question 4, 4A and 4B. Talks about fair value measurement again. But you said we've not done fair value measurement. Okay.
What year, sir?
Recognition. Passenger, please help me out. Oh God, where did I see this the recognition now? And I thought I mentioned that the recognition. No. I can't find the question again. Oh God. I'm coming. Oh God, I saw this question today. IFRS 15. I saw that question this evening, just this evening. I gave us question 4 of May 2024, Abby, for Liz. Abby?
yes, sir.
Yes.
I have two Liz questions. November 2020 question 5 as well. I think it was November 2020 question 5 I gave us before. Yeah, I've seen it. November 2020 question 5. It has Liz and it has IFRS 9, the recognition rules. Let's go into that question. We can solve it within the next 20 minutes. And then we call it a night. Now, next class, we start with Liz. Please take note. November 2020 question 5. We are solving it now. We also have Liz question there. And also May 2024 question 4. Liz. May 2024 question 4. Please, let's take note of it. Now, fair value measurement. If you have not done it, I think we should look at it. But we have a lot to do. I gave us all the topics to be covering, right? Did I give us in the last class?
Yes, you did.
I'm sure I did, sir. But yeah, let's go to November 2020. Question 5, please. November 2020, question 5. Let's solve that under the remaining 10, 15, 20 minutes. Yes, anybody?
Can we read, sir?
Yes, please go ahead.
Okay, question 5. Muzana Limited owns tractors used for farming purposes and sometimes enters into lease arrangements with other agricultural companies. A particular tractor, when leased by Muzana, is for 8 years. The useful economic life of each tractor is estimated at 10 years, while the fair value of each tractor is estimated at 26 million. The present value of minimum lease payment in the lease arrangement is 28 million. Lease payments are made to Muzana by the lease on a monthly basis and has purchased option at the end of the lease term to acquire the machine for 2.2 million. A similar fairly used machine in the market will cost the buyer 2.5 million. Following the transition to IFRS 16, the management of Mozana has classified the lease as an operating lease in its year-end financial statement. In order to expand its operations, Mozana accessed the Agricultural Loan Credit Program set up by the government of Nigeria in the year 2016. Mozana was granted a 5-year interest-free loan on 100 million. At year-end September 30, 2019, Mozana had been able to set aside 100 million in a special trust to be used for no other purpose than to pay off the loan in full on its due date in 2020. The management of Mozana are currently preparing their year-end 2019 financial statement and have recognized the loan liability due to the fact that funds has been set aside in full to satisfy the loan payment in 2020. Mozala Limited have just concluded a meeting with its tax consultant. The amount due to the state tax authority in the current year is 2.3 million. Mozana also has a tax credit of 1.8 million due for the federal government in the current year. The tax consultant has advised Mozana that this amount can be offset in their year-end financial statement to show only a tax liability of 500,000 required. Explain how the lease arrangement should be classified in Mozana 2018 year-end financial statement. B. Advise the management of Mozana based on IFRS 19, the recognition rules, if the loan liability can be recognized in their year-end September 30, 2019 financial statements. So I think that is the
Sorry,
question.
I actually thought I'm sharing the money. And no one reminded. Okay, so we have Mozana here. Question 5. That person can mute, please. Okay. Now, we have to do question 5B. Based on IFRS 9, the recognition rules. If the loan can be recognized in their year-end September 30th, 2019 financial statement, right? Advise the management based on the recognition rules. Yes? How do we recognize?
Okay, sir. Sir, can I try?
Yes, please go ahead.
Okay, so since the loan is a liability to the company, and for it to recognize a liability, that means obligation is settled,
Okay.
capitalized,
One.
or expired.
Two.
So in this
There are
in this
other
case,
rules. Obligation is settled, or it has expired, or it has
or
been
capitalized.
cancelled, or it has been discharged.
Okay, sir. Yes, sir.
Go ahead.
So in this case, they have set fund aside for it. So to them, it has been settled.
Okay.
So they should recognize it. On the
All
other
right.
side, they should not recognize because the payment has not been made, although they have set fund aside.
Okay. Yes, any other person? Any other person? Now, don't forget, we've recognized this in year-end 30th September 2019, right? When are we supposed to repay the loan? . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . When are we supposed to pay the loan? When is it? When is it?
That's 2020.
2020. Right? Now, at year end September 30th, 2019, Muzana had been able to set aside 100 million in a special trust to be used for no other purpose than to pay off the loan in full on its due date in 2020. So, which means Muzana has actually made provision for it. Right? But it is not due yet until 2020. Am I right?
Yes.
So can we recognize this loan? Can we recognize it? Can Muzana recognize? So let me take it. So that we don't waste time. Now, when we say the recognition, right? We have four, just like I said. The general name is that when you want to recognize like that, it means you have extinguished the liability. Okay? And when we say extinguish the liability, we are talking about four different things. It could be that you have discharged the liability, or you have cancelled the liability, or the liability has expired, or you have settled it. Do you understand? Unless those four things are there, you cannot recognize a liability. Right? Now, when the liability is fully recognized or any of those things have occurred, you recognize. Now, for Muziana, can Muziana recognize? No, we cannot. Why can't we recognize? We have seen in 2019, yes, adequate provision has been made for that amount, 100 million naira in 2020. Right? Now, is there anything that could say that probably Muziana would want to settle that liability or would want to discharge that liability before 2020? No. They are currently preparing for 2019 financial statements, and they have recognized the loan due to the fact that they have set aside in full the they've made provision for it in full. Can we recognize? No, that is wrong. You cannot recognize 2020 loan in 2019. You have to wait till 2020. So you are not expected. Muziana Limited cannot recognize the loan until the loan is fully discharged in 2020. You only made provision in 2019. Are we together?
Yes.
We made provision in 2019. But we cannot recognize it in 2019. All right? So that's it. Any question?
So I thought you wanted to give us the recognition rule.
The recognition rule. Right? Now, the recognition itself, like I said, the recognition is when you remove the financial instrument from your financial statement. When you stop recording the financial instrument from your financial statement. Do you understand? Do you understand?
Yes, sir.
Very clear, yeah.
So that is when you derecognize. Now, for you to derecognize, four things must have happened. Is either you have discharged the liability. What do I mean by discharge the liability? You have paid up that liability. That is, you have waited till 2020 and settled the liability. You have paid. That is to discharge it. Or you have cancelled the liability that, see, I am not owing you again. You are not owing me again. Or the date for that settlement has expired and everyone has gone their way. Right? Now, those are the ways you can say that a liability has been extinguished or it has been derecognized. Do you understand? It's either you cancel it, you discharge it, or it is expired, or it is settled. Until those four things are there, you cannot derecognize. Now, the question is this: has Muzana settled the liability? Huh?
No,
No.
not yet.
No. Has the liability been discharged?
Not yet.
Was it cancelled?
No.
Has it expired?
No.
Now, when those four things are not there, it means Muzana cannot derecognize. Do you understand? Until those four things are there, you cannot derecognize. You made a provision does not mean you have settled the liability. You are owing me 1 million naira, and you are supposed to pay me next week. You are supposed to pay me on Sunday. You already have my 1 million naira with you. You kept it, or you made a provision for it in your account. Have you paid me? No. So you are still owing me until Sunday when you promise to pay me. That is when we look at the transaction again. Do you understand? So Muzana cannot derecognize. Muzana cannot derecognize the liability. Are we there?
Yes, sir.
Muzana cannot derecognize the liability.
Sir, please, could
And
you
that's what we
mention,
have. Any question?
yes, sir, please, could you mention those criteria of the recognizing a liability again?
Is either it is settled, is either the liability is settled, eh? Are you there?
Yes, sir.
Is either the liability is settled or is being discharged. Discharging, to discharge it means to settle it as well, right?
Okay.
Discharged, cancelled, or expired.
Okay. Thank you, sir.
You're welcome, man. Any question, please?
Excuse me, sir. May I ask something?
Go ahead, sir.
Okay, as it has to do with the expiry of liability, you might have situations where the other party may want to take legal action. Would that still hold as having expired? Maybe.
Sorry, I'm not getting that.
Hello, can you hear me, sir?
I can hear you, but your voice is very low and don't seem to understand it. Just tell me, please. Go ahead.
Okay, I say you just mentioned expiry of a liability.
Mm.
In a case where the other party intends or seeks to extend that liability by way of legal action, will you still derecognize?
I don't understand. Where what?
Where the other party intends to seek legal redress to extend that liability, will you still derecognize?
Okay, seek legal redress. You extend the
Yes.
liability,
Yes.
right?
Yes, sir.
I want to understand you. Okay, fine. So you're looking at someone has a liability and it is extended or expired, and then the other party wants to take a legal action. Abi?
Yes, sir.
Yes. As the liability is settled, no, you still recognize it as a liability. Do you understand?
Okay, sir. Okay, sir. Thank
It's
you,
still
sir.
be recognized as a liability. Any other thing? any other thing? In the absence, please prepare for Liz. Read, oh. Huh? Please read, oh. I'm begging you. Please read so that we can do Liz in our next class. I'll see you all in the next class. Have a wonderful night. Have a night rest.
Thank you, sir. Good night, sir.
Thank you, sir.
Good night, everyone.
Thank you, sir. Good night, everyone. Good night, everyone. Thank you, sir.